If you own any of these five stocks right now, you need to get out before 2026. I'm not being dramatic. I'm looking at the data, and what I'm seeing should terrify anyone who's serious about protecting their wealth. This isn't about short-term volatility. This is about structural collapse. And if you ignore this warning, you could watch decades of disciplined investing evaporate in months. I'm Kevin O'Leary, and I don't sugarcoat things when it comes to your money. I've been doing this for 40 years. I know what works and what doesn't. And what I'm about to tell you comes from cold, hard experience watching investors lose everything because they refuse to face reality. Here's what most investors don't understand. We're heading into 2026 with three massive structural problems that are about to converge. First, interest rates are staying higher for longer than anyone expected. The Federal Reserve told us rates would come down. They lied, or they were wrong. Either way, the result is the same. Companies that loaded up on cheap debt during the pandemic are now facing refinancing at rates that are 3, 4, sometimes 5 times higher than what they were paying. Second, we've got an economy that's slowing down. Consumer spending is weakening. Credit card debt is at all-time highs. Savings rates are collapsing. The average American has less than $400 in their bank account for emergencies. That's not a recipe for growth. That's a recipe for disaster. Third, we've got entire sectors built on fantasy, built on hype, built on the belief that profitability doesn't matter as long as the story is good enough. That worked when money was free, when venture capitalists and retail investors were throwing cash at anything with a pulse. But that era is over, and the companies that can't generate real cash flow, real profits, real returns are about to get crushed. Now, I've seen this movie before. I saw it in 2000 when the dot-com bubble burst. I saw brilliant people, smart people, disciplined people lose everything because they held on too long. They believed the hype, they ignored the data, and they paid the price. So what I'm about to show you isn't speculation. This is pattern recognition. This is decades of experience looking at balance sheets, cash flow statements, and market dynamics. And what the data is screaming at me right now is simple. Get out of these five stocks before it's too late. The first category you need to exit immediately is commercial real estate investment trusts focused on office space. I'm talking about R8s that derive the majority of their revenue from office buildings in major cities. And here's why this is a death sentence. Office vacancy rates in major U.S. cities are sitting at historic highs. We're talking 20%, 25%, in some markets, even 30% vacancy. That's not a temporary blip. That's structural. Companies figured out during the pandemic that they don't need massive office footprints. Remote work isn't going away. Hybrid work isn't going away. And even the companies forcing people back to the office are doing it with smaller spaces. Office vacancy in San Francisco hit 36.7% in Q3 2024. New York is at 22.3%. These aren't recovering. They're getting worse. But here's where it gets catastrophic. Most of these REITs borrowed heavily when interest rates were near zero. They've got billions in debt that needs to be refinanced in 2025 and 2026. And when that debt comes due, they're not refinancing at 2% or 3%. They're refinancing at 7%, 8%, maybe higher. The math doesn't work. The rental income they're collecting can't cover the new debt service. They're going to default. They're going to sell assets at fire sale prices, and shareholders are going to get annihilated. I've seen this exact scenario play out in the late 1980s with the savings and loan crisis. Commercial real estate crashes are slow, then sudden, and when they break hard. If you own any rate-heavy and office buildings, you need to exit now, not next quarter, not after you see how things develop, now. Second stock on the list, Boeing. And I know this is going to upset some people. Boeing is an American icon. Boeing is defense. Boeing is aerospace. I don't care. The numbers don't lie. Boeing has been in crisis mode for years. The 737 MAX disasters destroyed their reputation and their cash flow. Then we had production delays, quality control failures, and now we're seeing massive order cancellations and delivery postponements. Airlines are furious. Regulators are breathing down their neck, and the company is burning through cash at a rate that should terrify any rational investor. Boeing reported negative free cash flow of over $3 billion in recent quarters. They've got over $58 billion in total debt. Here's the real problem. Boeing's problems aren't fixable in the short term. Rebuilding trust in aviation takes years, sometimes decades. Every time there's another incident, another headline, another investigation, it reinforces the narrative that Boeing can't get it right. And in an industry where safety is everything, that's a death spiral. Now, I know the bull case. Boeing is too big to fail. They're a defense contractor. The government needs them. Maybe. But even if the government bails them out, that doesn't mean shareholders make money. Look at General Motors after 2008. The company survived, the shareholders got wiped out, Boeing might survive, the brand might recover, but the path from here to there is going to destroy shareholder value. And if you're holding Boeing stock hoping for a turnaround, you're not investing, you're gambling. And gambling with your retirement savings is how you end up eating cat food in your golden years. Third on the list, Oracle. Now, this is going to surprise some people because Oracle is profitable. Oracle generates cash. Oracle pays a dividend. So why am I telling you to get out? Because Oracle is a legacy enterprise software company trying to compete in a cloud and AI world where they're getting crushed by Amazon Web Services, Microsoft Azure, and Google Cloud. Oracle's cloud infrastructure business is growing, but it's a fraction of the size of their competitors. And in technology, second place is first loser. Oracle's cloud infrastructure revenue was approximately $2 billion in recent quarters, compared to AWS at over $25 billion quarterly. They're not even in the same league. The problem with Oracle is simple. Their core business, the database licensing and maintenance business that prints money, is slowly dying. Companies are moving to cloud-native solutions. They're moving to open-source databases. They're moving away from the expensive, locked-in Oracle ecosystem. And Oracle's response has been to acquire companies and rebrand existing products as AI and cloud. That's not innovation. That's desperation. Now, could Oracle surprise us? Could they execute a turnaround? Sure, anything is possible. But when I look at the competitive landscape, when I look at the rate of technological change, and when I look at Oracle's track record of innovation over the past decade, I don't see a path to long-term dominance. I see a slow, grinding decline punctuated by short-term rallies driven by financial engineering, not fundamental growth. Smart investors don't bet on hope. They bet on data, and the data says Oracle is losing the war that matters. Fourth category, unprofitable technology companies, especially those in the artificial intelligence space. And I'm talking about the venture-backed, cash-burning, story-driven companies trading at insane valuations despite having no clear path to profitability. These are the companies that raised hundreds of millions, sometimes billions of dollars, promising to revolutionize everything with AI. And maybe they will, but maybe doesn't pay your bills, maybe doesn't fund your retirement, maybe doesn't put food on the table. Here's the brutal truth about unprofitable tech companies in a high interest rate environment. They die. When money was free, when venture capital was flowing like water, these companies could raise round after round and keep burning cash, but that era is over. Investors want profitability. They want cash flow. They want to see a business model that actually works. Over 60% of AI startups that went public via SPAC or direct listing in 2021, 2022 are now trading below their debut prices. Many are down 70%, 80%, even 90%. I don't care how revolutionary your technology is. I don't care how big your addressable market is. If you can't generate positive cash flow, you're not a business, you're a science project. And science projects don't belong in a retirement portfolio. Now, some of these companies will figure it out. Some will find product market fit, achieve profitability, and become the next Amazon or Google, but most won't. Most will burn through their cash, fail to raise another round, and quietly shut down or get acquired for pennies on the dollar. And if you're holding shares when that happens, you lose everything. This is not about being anti-innovation. This is about being pro-survival. If you want to speculate on unprofitable AI companies, fine. Do it with money you can afford to lose. But keep it out of your core portfolio. Keep it away from your retirement savings. Because when these companies implode, and they will, you don't want to be holding the bag. Fifth and final stock, Broadcom. Now, this one is controversial because Broadcom is a profitable company. They've got real revenue, real cash flow, and they've executed well on acquisitions. So why am I warning you about it? Valuation, pure and simple. Broadcom's stock has been on an absolute tear, driven almost entirely by AI hype. The company makes chips and software that are essential for AI infrastructure. That's real, but the stock price has run so far, so fast, that it's now priced for absolute perfection. Any stumble, any miss, any slowdown in AI spending, and this stock is going to get crushed. Broadcom's price-to-earnings ratio has expanded significantly, trading at multiples well above historical averages. The stock is up over 400% in recent years, far outpacing revenue growth. Here's the problem with momentum stocks trading at nosebleed valuations. They only go in one direction until they don't, and when they turn violently. I've seen this pattern my entire career. A stock becomes a must-own. Everyone piles in. The valuation becomes disconnected from fundamentals, and then something changes. Maybe earnings disappoint, maybe a competitor emerges, maybe AI spending slows down. Doesn't matter what the catalyst is. What matters is that when these stocks break, they don't fall 10% or 20%. They fall 40%, 50%, 60%. Now, I'm not saying Broadcom is a bad company. I'm saying it's a great company at a terrible price. And in investing, price is everything. You can buy the best company in the world and lose money if you pay too much. And right now, Broadcom is priced for a future where everything goes right, where AI spending continues to accelerate indefinitely, and where no competitor ever catches up. That's not investing, that's fantasy. If you own Broadcom and you've got massive gains, take them. Lock in your profits. Don't let greed turn a winning trade into a losing position. Because when this stock corrects, and it will, you're going to wish you had sold when you had the chance. Now, let me tell you why this matters more than you think. Every single one of these positions represents a different type of risk, but they all share one common thread. They're built on assumptions that are breaking down right in front of us. The commercial real estate REITs assume office demand will recover. It won't. The structural shift to remote and hybrid work is permanent. Even if companies mandate returns to office, they're doing it with smaller footprints. The math doesn't support the old model. And when you combine falling rental income with rising interest rates on refinanced debt, you get a perfect storm of financial destruction. Boeing assumes they can fix their reputation and operational problems quickly. They can't. Aviation is an industry where trust is earned over decades and lost in seconds. Every quality control failure, every delayed delivery, every negative headline reinforces the perception that Boeing is broken. And in a duopoly market where Airbus is executing flawlessly, Boeing's market share is going to continue eroding. Oracle assumes they can compete with AWS, Azure, and Google Cloud in the infrastructure wars. They can't. The gap is too wide, the competitors are too strong, and Oracle's core database business is slowly dying as the world moves to cloud-native, open-source alternatives. This is a slow decline masked by financial engineering and occasional acquisition-driven growth. But the trajectory is clear. The unprofitable AI companies assume the hype will last long enough for them to figure out a business model. It won't. Money is no longer free. Investors want profits, and companies that can't demonstrate a clear path to positive cash flow are going to find themselves unable to raise capital. When the music stops, most of these companies won't have a chair. And Broadcom assumes AI spending will accelerate indefinitely, and that competition won't catch up. That's a bold assumption priced into a stock that's already up 400% in a few years. When reality falls short of these astronomical expectations, the correction is going to be brutal. Here's what you need to understand. Protecting your wealth isn't about finding the next big winner. It's about avoiding the catastrophic losers. One bad position can wipe out years of gains. I've seen it happen. I've watched intelligent, successful people lose 50%, 60%, 70% of their net worth because they held on too long to a sinking ship. When I was building my education software company, we had this one project that everyone loved. The team was excited. The story was compelling. But when I looked at the numbers, it was clear this project was going to lose money, and I killed it. People were upset. They didn't understand. But I understood something they didn't. Capital preservation matters more than ego. Protecting what you have is more important than chasing what you might get. That's the mentality you need right now. Look at your portfolio. Look at these 5 positions and ask yourself, am I holding this because the fundamentals support it, or am I holding it because I'm hoping for a miracle? Hope is not a strategy. Hope is how broke people stay broke. Smart investors make decisions based on cold, hard data, and the data on these 5 stocks is screaming at you to get out. Now, I know what some of you are thinking. What? But Kevin, what if I'm wrong? What if these stocks go up? That's the wrong question. The right question is, what if I'm right? What if these stocks collapse? Can you afford that loss? Is the potential upside worth the very real downside risk? When I look at these positions, the risk reward is terrible. You're risking significant capital for what? A 10% gain? A 20% gain? Meanwhile, the downside could be 50%, 60%, 70% or more. That's not a trade I would ever take, and if you're serious about protecting your wealth, it's not a trade you should take either. This is about discipline. This is about recognizing that sometimes the best trade is the one you don't make. Sometimes the smartest decision is to sell, take your chips off the table, and wait for a better opportunity. Because opportunities always come, but only if you have capital left to deploy. The investors who got destroyed in 2008 weren't stupid. They were just stubborn. They believed the narrative. They ignored the warning signs. They held on too long, and they paid the price. Don't be that investor. Don't let stubbornness or hope destroy decades of disciplined wealth building. So let me summarize what we've covered. 5 stocks or categories you need to exit before 2026. First, commercial real estate REITs focused on office buildings, structural vacancy, refinancing crisis, and no path to recovery. Second, Boeing. Broken reputation, cash flow crisis, and years of operational problems that aren't getting fixed quickly. Third, Oracle. Legacy enterprise software company losing the cloud and AI wars to better capitalized, more innovative competitors. Fourth, unprofitable AI and technology companies. Great stories, no business models, and a funding environment that's about to get brutal. Fifth, Broadcom. Excellent company at a terrible price, trading at valuations that assume perfection in an imperfect world. This is about discipline. This is about making smart decisions based on data, not emotion. This is about understanding that protecting your wealth is just as important as growing it, maybe more important. The market doesn't care about your feelings. The market doesn't care if you like these companies or believe in their stories. The market cares about one thing. Can this company generate cash flow and shareholder returns? And for these 5 positions, the answer is either no or not at these valuations. Build a portfolio that can survive the storm that's coming. Exit these positions. Move into assets that generate real cash flow, real dividends, and real value. Don't wait. Don't hesitate. The clock is ticking. All right, if you found this valuable, I need you to do something for me right now. Smash that like button. Share this video with your friends and family. They need to hear this message. Too many people are going to lose money in 2025 and 2026 because they're holding positions they shouldn't. Don't let that be you. Don't let that be the people you care about. Leave a comment. Tell me what you think. Tell me if you're holding any of these stocks and whether you're planning to exit. Tell me what you're seeing in your portfolio. This community thrives on intelligent conversation and shared experience. Consider becoming a member of this channel for exclusive content. We dig deeper into investment strategies, portfolio construction, and wealth preservation techniques that most people never learn. We're building a community of serious investors who understand that wealth is built slowly, methodically, with discipline and patience, not chasing hype, not gambling on hope, but making cold, calculated decisions based on data and experience. The next 12 to 18 months are going to separate the smart investors from the broke people, the disciplined from the emotional, the survivors from the casualties, and I want you to be on the winning side of that equation. Stay smart, stay disciplined, and remember, protecting your wealth is the only thing that matters, because if you don't have capital, you can't invest, and if you can't invest, you can't build the life you deserve. Now go look at your portfolio, make the hard decisions, and position yourself for survival and success in 2026 and beyond.